Hi guys, my name is Tom. Welcome to this week's video on option trading versus stock trading. Over the course of weeks and months, we're going to teach different options terms, strategies, and techniques to our viewers. Our ultimate goal is to educate you about the wonderful, highly profitable world of option trading. As always, don't forget to click the link to subscribe to this page and receive alerts when they are posted. Please also check out our social media pages on Facebook, Instagram, and Twitter. So let's jump into this week's topic, which is option trading versus stock trading. Before we do that, we just want to do a quick refresher on what is an options. Well, an options are contracts that give the bearer the right, but not the obligation to either buy or sell an amount of some underlying aspect at a predetermined price at or before an expiration date. Options contracts are financial agreements between two parties to facilitate a potential transaction on the underlying security at a price called a strike price prior to an expiration date. When you buy an options contract, you are choosing to either exercise your options contract on or before the expiration date or simply allow the option to expire unexercised. Options are an example of a derivative. A derivative's price is dependent or derived from the price of something else. So, a good example of derivative, wine is a derivative of grapes. Fruit juice is a derivative of the underlying fruit. And options contracts are a derivative of stocks. There you are. That's how they're priced. And that's why, people talk options and stocks because they're interrelated. They're directly related. So let's have a look at stock trading versus option trading. Well, stock traders purchase a small ownership in a company. When you buy one or more shares, you're purchasing a small part of the company that issued the stock. The ultimate goal of buying shares is to sell them at a higher price, which would be capital gain, or some stocks also have the added benefit of paying a dividend. While options traders are essentially purchasing the right to buy or sell shares of an underlying stock for a set price at a future date. However, there is no ownership in the company. You do not have opportunity to earn dividends on options trading. You also don't have the opportunity to vote and some other aspects of it. The only profit from option trading is from capital gains or premium received if you are selling options contracts. Now, like I said previously, when you buy an options contract, you're essentially betting on which way a stock moves without having to own the underlying stock. So, what's an advantage of option trading versus stock trading? Why would you do it if you miss out on the added benefit of, potentially dividends, voting, and also the security of owning a portion of the company? Well, let's look at it, and then let's start with the pros. I always start with the pros, and then we'll get to the negatives a little bit. So, why option trade? Well, options traders have increased cost efficiency. Options have increased leverage power, meaning an investor can obtain an options position similar to stock position, but a fraction of the price. Let's say Amazon shares. Amazon shares are historically very, very expensive. So over $1,000, well over $1,000. And if you want to get into investing in them, you need, a lot of money to make a lot of money. However, you can buy an options contract, would be a fraction of that. And you still get the added benefit of, if you believe it's going to increase over the long term, you still get the added benefit of the profit and the capital gains. And a good example is that for an investor purchases 200 shares of a $100 stock. Okay, the investor must pay $20,000. So 200 shares, $100 stock, $20,000. However, the investor were to purchase a $5 call option. The contract represents 100 shares. Like we spoke about, one contract represents 100 shares. The total outlay would be $500, which is the contract price of $5 times 100, which is the contract price. The investor would have an additional $19,500 to use at his discretion. So that example was he put $20,000 all in this one company, hoping it went up. However, he then instead of buying stocks, he bought an option contract for that company at $500. He now has $19,500 to invest wherever he wants to go. Now let's look at some more benefits of it. Can potentially be less risky than stocks. Options can be less risky because they require less financial commitment. Directly links back into it. You don't have to put all your money in one bucket with options trading. You can, because it costs less, you can really diversify. You have $1,000, instead of putting in one company, you can diversify into 10 companies. They can potentially deliver a higher percentage return. Because one options contract represents the ownership of 100 shares, that it amplifies the returns on the upside. Also amplifies the losses on the downside. But we're doing advantages at the moment, only positive stuff. Finally, options offer strategic alternatives. So options are very flexible investments, and why they're so important. They offer a variety of alternatives. The use of options allows investors to trade three-dimensionally. What does that mean? Well, options allow investors to trade not only the stock movement, but they can also trade a period of time. They can trade on volatility. Option traders, if you get really good at it, and that's what we want to get at, is that you make money during uptimes, you make money during downtimes, and you make money when it's also volatile, and also when the market's flat. Learning about different options, you can pick a strategy based on the market conditions. And stock trading doesn't have that flexibility built into it. So that was the advantage of it. Well, let's look at the flip. Let's look on the other side and look at the disadvantage of it. Okay. Options, the first one is pretty clear and you can't really do much about it. So options are not available for all stock, and information can sometimes be limited. Options are not available in every listed company, and even when they are, sometimes the available information can be extremely limited. That is an important point if you're looking to trade options on, let's say, penny stock companies, little-known companies. If you're trading on foreign exchange accounts, sometimes they don't have options for even the large companies. Options are at the discretion of the company and also the market and if they allow it or not. So that's an important point to realize that, it might not be, you might love it, but you might not be able to do it with every single company. As I previously mentioned, you do not receive a dividend. Pretty simple. Only shareholders receive a dividend, not options contract holders. Pretty simple. You can lose it all. This is one of the extreme negatives of option trading. When you buy a stock, it is extremely rare for the stock to be worthless when you attempt to sell. And the only way when you buy a stock in a company, the only way that you lose 100% of your investment is if it goes bust, if the company goes bankrupt. Now, can that happen? Of course it can happen. But that is rare. If you look at historically all the companies that get listed on the major stock exchanges around the world, it's very rare for a company to go fully belly up. And also, if a company does go bankrupt, it doesn't happen overnight. It's slowly over time, the share price goes down and down. So it enables the investor, okay, well, they're in the dumps. They don't look like they're going to come out of it. You can pull your money out and still save something. With options, you can lose it all very quickly. If you buy a stock and it has a short expiration date and you're hoping it goes up because of a good quarterly return, and it doesn't and it goes down, you could lose it all within seconds. So that's an important point to remember. And it also links into the next important point. So buy and hold strategy does not work. So if you're a fundamental investor, there's a strategy called buy and hold. And the reason behind this is pretty simple, and it's that law of averages. The market around the world will go up in value on average every year. Some years they go up by 2%, 3%, 5%. Some years they will go down. But if you averaged it out over the year, you'll eventually see it go up and up and up and up. It's simple. Inflation, that's why it happens. That's why the cost of living goes up, because, we're earning more. Bread cost significantly less 100 years ago than it does now. In 100 years' time, bread's going to cost more in regards to that. So that means you can buy a stock. Let's say you bought anything, any company, and just held on to it for 50 years. The good average will be that you'll make money on it. You might not make a lot of money on it. It might not be the best investment, but you should make money on it. You cannot do that with options contracts. Normally, the longest option contract is 2 years. So the buy and hold over 2 years just doesn't work. And even that 2 years, that's not on every single options contract. When we get into expiration date and talking about that, I'll show you how sometimes some companies only allow it to be, 1, 2, 3 months, 6 months out. The more popular ones, which have a lot of volume, definitely will allow you to trade further out. And then finally, complicated. Gonna say yes, options trading can be complicated. You need to go into it with a broad sense of mind because it's a very unique instrument. Your trading options contract are very unique because you don't own anything. There's no ownership of it. You're not a stockholder. You don't have anything. You're trading the value of a share without owning the actual share. So once you get your head around that concept, it starts to make sense. And then once we do get into some more advanced strategies, they do get a bit complicated because it involves multiple steps and multiple calls and puts at simultaneously different expiration and strike prices. But don't worry, you take it one step at a time and you break it down to simple steps and it makes sense. So that is the advantage and disadvantage of stock trading versus option trading. Thank you so much for watching our weekly video. If you've liked this page, please check out our website at the link below, as well as our social media pages on Instagram, Facebook, and Twitter. It has been a pleasure sharing this information with you this week. We can't wait to see you next week. Thank you.